In this video, I'm going to share with you 5 mindset shifts that will completely change the way that you invest. Hopefully, it will help you become a better investor. It will certainly make you feel more confident and peaceful about your investing. Hi, I'm Camille Gaines here, and on my website, retirecertain.com, I write about and I talk about investing. I'm not trying to sell you wealth management services. I like investing. I think it's super, super cool and super important. It's interesting. There's always more to learn, and that's what I get to talk about here with you. So thanks for being here and listening. These 5 mindset shifts are things that I've learned over the years. I bought my first investment when I was in my early 20s. As you can see, that was a really long time ago. And I've bought just about everything since then, except for crypto, which I just don't quite get, so I haven't bought it yet. But having said that, the very first mindset shift I want to share with you, and I'm going to refer to my notes or make sure I tell you everything that I want to tell you, and that is to set a minimum acceptable return for your money. Okay, so what I mean by this, and let me just sort of expand. When we use our money, when we invest, we're using our money because we expect an outcome from the use of our money. We're allowing that investment or that asset to take our money from us because we have an expected outcome. That's just like if I go buy a coat, I have an expected outcome. That coat is going to keep me warm. It's going to be something I can wear when I walk Blanco, my Labrador, maybe a hood, maybe rain. I have specific things that I'm buying that coat for. I'll buy a different coat if I want warmth when I make the occasional trek to New York, or I'm in cold weather in a city. It'll be different. Investing is no different. We use our money because we have a desired outcome, and we get to demand that. We get to expect that from our hard-earned capital, our investment savings, our capital. We don't think about that with investing, though. We've lost sight of that with all the focus on asset allocation templates and, buy and hold no matter what, and everybody do the same thing and follow this template. We've lost sight of the fact that we're using our money for an expected return, for an expected result. So set your minimum acceptable return that you're willing to get from your investments and invest accordingly. This means that when you buy an investment, you'll look and see if it's likely that you're going to get that return that you've set over the time frame that you want to get that return by. And that's key, because it's going to be completely different if it's 3 years versus 20 years or 30 years. So keep it in mind, the time frame, but also, more importantly, keep in mind that you get to set an expected minimum return that is acceptable to you. Set it as a goal for your investing, and that goal is going to tie directly to financial independence for you, financial freedom for you, whatever your goal is. For a lot of people, that's reaching retirement, enough retirement savings. So whatever that is that you're going toward, and whatever return you have to get there, that's your minimum. That's your minimum. And invest from that place. All right, make demands of your investments. Okay, the next thing is to consider yourself the CEO of your wealth. There's so much I could say about this. I think that a lot of people, when they use a financial advisor, as many people do, or when they put money into maybe a 401k or a retirement account, their options are very, very limited. Or it may come with some sort of advice, and they feel like someone else is in charge of their investments. That's just not true. And the reason it's not true is because fast forward 10 years, 20 years, 30 years, you run out of money. Who's going to suffer? Is it going to be you or that person that you thought was in charge of your investments? It's going to be you. And if your investment returns do turn out great and your investments grow and you get the results you want, who gets to celebrate and enjoy that? You, not the financial advisor or investment advisor or HR person, whoever was advising you on how you should invest your money. So think of yourself as CEO of your money. That's not to say you shouldn't ever outsource or the investing or the management of your money. You're that person, you're the CEO, and you're hiring that person to get the results that you want. Now, a lot of the times what happens is people hire a financial advisor and they think, oh gosh, I'm so glad I've gotten that off my plate. They know more than me. I don't have to worry about that anymore. It's so wrong. And I learned this the hard way. You may have seen my other video where I talk about how I learned this. You've got to know enough about investing, and kind of a lot, to interview, to monitor, to evaluate financial advisors that work for you, because you're paying them a whole bunch of money. And you've got to evaluate their performance. There is no other job where you wouldn't be evaluating performance. And so many people don't do this with financial advisors for some crazy reason. So think of yourself, you're the CEO of your wealth. It may also be that you need to hire a CPA or an attorney to work with you on estate planning, whatever it is. But you're the person that's in charge of your money, and make it your job. It's a very, very fun job, and it's a gift to have that job. If you have money to invest and to manage and to oversee, it's a gift. All right, the next mindset shift is to estimate investment risk. I like to say to calculate your stock drop factor. I haven't talked about this in a good long while, so you may have not heard me talk about this, but your stock drop factor is about how much money you would stand to lose if the stock market went into a bear market. Now, I refer to stocks here a lot. I'm not always invested in stocks, but most people that watch my channel and most investors are invested in a stock and bond portfolio because that's how we're told to invest, and most people still think that's how you should invest, which is a whole other video. But having said that, most of you own stocks if you're watching my channel. So the stock drop factor is simply looking to see how much risk you have from the stock market at any given time. We know that historically the average bear market drop has been around 35%. So just go through your portfolio and add up everything you've got in the stock market times 35%. And that's about how much, based on the historical average of bear markets, you could expect from a bear market. Now, we also know this really depends on the stocks you're invested in. The NASDAQ dropped well over 70% in the tech bust. S&P 500 dropped about 55% from the 2008 bear market. So, we have a lot worse drops than 35%. So only you can decide what percent you want to use for your stock drop factor. I'm not saying 35% is adequate. It's really not for me, because I think that given the situation right now with the economic factors and conditions, that's not enough for me personally. But you have to decide how much you think your risk is. And the reason you want to do this is because once you've done it, you can decide, I can live with this. All right, okay, I could handle a 100,000 drop or 500,000 drop or whatever it is, $10,000 drop. I can handle this. I would be okay with this, and I wouldn't bail out at the very, very bottom if this happened. Or you could say, you know what? I'm not okay with that. I'm going to invest my portfolio differently and take action and do that. You can see how powerful just doing this is. It changes everything. It leads you to take action if it's not okay. It prevents you from making emotional decisions because you were prepared for it. You had gone through the math. The math doesn't lie. And this is huge. So calculate, estimate your stock drop factor at any given time. You can do this for any asset that you own. It doesn't just have to be stocks. home values decline during recessions and or related bear markets, whatever assets that you own. But in particular, the stock market, the math, the historical data there is pretty reliable for us to be able to do this. You just have to pick that range that you want to use for your percent decline. Okay, the next mindset shift is to truly understand investing and what drives investment returns. And people like shortcuts. I like shortcuts. I love shortcuts. We all want shortcuts, and we've bought into, for the past 2 or 3 decades, the shortcut is the asset allocation template. The asset allocation template, you know, whether it's your age minus, or 100 minus your age, you know, and then you put this much in stocks and this much in bonds based on that formula, which I've talked about in other videos, or whatever it is. We all like those shortcuts. We like templates. I just don't think that's good enough. I really, really don't. Because what it completely overlooks is the fact that economic cycles affect, they drive your investment returns. Your investment returns are a result of what's happening in the economy, whether the economy is expanding or contracting, whether interest rates are rising and falling, and other things that are happening on a macro level. And I think over the next decade, more and more investors are going to get sophisticated about this. I think it's going to change as we get more data, more information that really empowers us, the individual investors, to make better decisions, to be able to invest smarter and more tactically than simply following these little asset allocation models that just... So really learn about investing, really understand investing. I like to really teach my coaching clients what all the options are. You know, okay, you could do this, or you could do this, you could do this, this, you know, and here are the pros and cons of each. And then you can pick out what it is that makes sense for you. What happens is we kind of buy into what everybody else is doing and what we're hearing in the news and the prominent information that's being thrown out on the internet, and we think that's the only way. But there are a lot of different ways to invest. And once you educate yourself on what those different ways are, you can decide what makes sense for you. Because investing really is, it's sensible. A lot of people don't realize it's very, very sensible. Okay, the next thing, this is very fun. Thank you for watching my video. If you like this information, please subscribe to my channel. That little thumbs up button after you subscribe, or no, you know, it's a little bell. After you subscribe, you'll get notified when I post a new video. The next thing I want to share with you, mindset shift, is, yeah, this is really big, and it's just following in on the last one, and that's don't assume that what everyone else is doing is the right thing to do. I mean, this is, and we're by our wiring, we're herd creatures. We like doing what everybody else is doing. It's part of our brain. It's what kept us safe during the cave dwelling days. To do what everybody else is doing, to stay with the clan, to stay with the crowd. That's where it's safe, and that feels safe. I see it in my videos here, or in the postings and the comments under my video. People are furious when I talk about things like I talk about that are a little different from what other people believe or teach or implement themselves, just because I've been investing for 4 decades, and that's shaped what I've seen and done. And we like to do what everybody else is doing, and at the moment that's still pretty much asset allocation in stocks and bonds, although I think people have gotten a little bit hurt from that in 2022 with the stocks and bonds going down together, and you know, that happens sometimes. But I've done a whole other video on that and why that the fallacy of the non-correlation between stocks and bonds. So make sure you check that out. But my point here is that if we look at people that have really built wealth, they haven't followed the crowd. They've done their own thing. They've thought independently. They've learned. Backing up to learning, the earlier point, they've learned, and they've invested based on what they've learned and what they saw, the data, the facts, the history, the math, because that doesn't lie. The cycles, what's happening, if we look around us, we can see what's happening. we can see if we're near the end, or we are, recently have ended that 40-year cycle in the lowering interest rate cycle. That's happening. That's happened. That affects the value of our stocks and bonds. So we have to just look at that, and we can't assume that what everyone else is doing or saying they're doing, some people are saying they're doing one thing, but they're not really. We can do better. It's a huge mindset shift, and it all goes back to being the CEO of your wealth. Excuse me, that's Blanco over there. It all goes back to being the CEO of your wealth and taking that role, that gift. It's really a gift to be able to do that and be that you do have that money that you get to do that with. Remember, retire certain.